Right, listen here. Build-A-Bear Workshop used to be the sort of company most investors sneered at. A tired mall chain selling squeaky toys to children, clinging to life in an era when malls themselves were dying. Today, it's 25 times more valuable than it was just 5 years ago. This unexpected comeback story is about a simple teddy bear company that has turned into one of the best performing stocks since the COVID-19 pandemic. And this story is different from the Gamestops and AMCs of the world. This rapid rise didn't happen because of hype. It happened because Wall Street ignored it. Back in 2022, Build-A-Bear nearly doubled its revenue from the year before. It was profitable, debt-free, and growing faster than many tech darlings. Yet the market valued the entire company at less than the revenue it had just earned. Imagine that. You could have bought the whole business for much less than a single year's sales. That's what investors call a hidden gem. Fast forward to 2025, and the results are absurd. Revenues keep climbing. Margins have become fatter than the stuffing in the teddy bears, rising to nearly 60%. And the stock chart looks like it belongs to a Silicon Valley disruptor, not a simple stuffed animal retailer. Over 5 years, Build-A-Bear delivered a staggering 2,500% return, leaving Nvidia, the most important chipmaker on Earth, trailing behind at just 1,200%. The lesson is as clear as it is humbling. The market doesn't always reward what sounds clever. Sometimes the biggest fortunes are made in places so ordinary, so boring, that nobody bothers to look. While analysts obsessed over artificial intelligence, a shop selling plush frogs and tiny bear-sized outfits quietly became a cash-printing empire. So today we're telling the full story, how Build-A-Bear went from a child's mall gimmick to a hidden gem, how it rebuilt itself after years of decline. Now do yourself a favor, hit that subscribe button. Because if a teddy bear company can embarrass the kings of Silicon Valley, who knows what other hidden gems are hiding in plain sight, just waiting to surprise us. Before we explore how Build-A-Bear became one of the most surprising comeback stocks on Wall Street, we need to take a step back, because the only way to understand this turnaround is to understand just how unlikely it was in the first place. To most investors, Build-A-Bear was never meant to be a serious company. At best, it was a fad. At worst, it was doomed the moment shopping malls began their long, painful decline. The story begins in 1997, when Maxine Clark, then a seasoned retail executive who had made her name at Payless Shoe Source, was shopping with a 10-year-old girl. The girl wanted a particular stuffed toy, but couldn't find it. Instead of shrugging it off, Clark spotted an idea hiding in plain sight. Why not let kids build the toy themselves? It sounds simple now, but at the time, most toy companies pushed mass-produced products onto shelves. The shelves dictated the choices. Children only chose from what was available. But Clark flipped the model entirely. She decided to create a store where children weren't just consumers. They were creators. That October, she opened the first Build-A-Bear workshop in the St. Louis Galleria Mall. From the outside, it looked like a colorful toy shop, but inside, it was something entirely different. An assembly line disguised as an experience. A child chose a limp, unstuffed bear skin from the wall. Then came the heart ceremony, where they picked out a tiny red heart, made a wish, and placed it inside. This magic brought these lifeless, heartless animals to something these young kids could have an actual connection to. Next, they operated a large stuffing machine, often with a staff member cheering them on, and watched their bear become even more alive. Finally, they dressed it in miniature outfits, gave it a name, and received a birth certificate. It was clever retail theater, a birthday party disguised as a product. And it worked. Within just 4 months, that first store generated nearly $400,000 in sales. Parents kept coming back because the experience wasn't just about the toy. It was about the memory of creating it, the ceremony of naming it, and the joy on their child's face. By the early 2000s, Build-A-Bear had become a bona fide craze. Within a few years, it expanded to more than 400 stores across North America, Europe, and Asia. At its peak, children's birthday parties at Build-A-Bear became a cultural moment. It wasn't enough to simply buy a bear off the shelf. Kids begged their parents to make one themselves, often dragging siblings and cousins along for the ride. And for parents, this was an activity, not just a purchase. A trip to Build-A-Bear was entertainment that doubled as a product sale. From a business standpoint, the genius lay in the upsells. The basic bear was inexpensive to produce and sold for around $10 to $15. But the real money came from the accessories: tiny t-shirts, miniature shoes, sunglasses, toy skateboards, even perfumes for the bears. Each of these add-ons carried fat margins, sometimes exceeding 60% gross profit. By the time a child left the shop with their bear fully dressed and accessorized, the bill often exceeded $50. In those early days, analysts called it the McDonald's Happy Meal of toys. It wasn't just about the bear, it was about the add-ons. Every child felt compelled to keep coming back for more clothes and accessories. From a business model perspective, it looked unstoppable. And yet, there was always a shadow of doubt. Retail analysts were skeptical from the start. Was this really a sustainable model? Or was it just another mall gimmick that would eventually wear off? After all, fads come and go. Remember Beanie Babies or Tamagotchis? Once the initial excitement died down, demand collapsed. Many believed Build-A-Bear would suffer the same fate. Still, the company pressed forward. By 2000, it launched an e-commerce platform, an unusually forward-thinking move for a toy company at the time. By 2004, Build-A-Bear went public on the New York Stock Exchange, raising capital to fuel further expansion. Investors were hopeful but cautious. The IPO was seen as a way to cash in while the trend was still hot. Through the mid-2000s, Build-A-Bear continued its global expansion, surpassing 400 stores worldwide and becoming a fixture in shopping malls. But its dependence on malls was also its Achilles heel. When the 2008 to 2009 financial crisis hit and malls began to hollow out, Build-A-Bear was caught in the crossfire. Parents cut back on discretionary spending, mall traffic plummeted, and Build-A-Bear, once seen as a rising star, suddenly looked fragile. By 2009, the company reported steep losses. From Wall Street's perspective, the business model's weakness had been exposed. Without strong mall traffic, the stores underperformed. Analysts predicted decline. Some went so far as to say Build-A-Bear would be the next Toys R Us, an outdated retailer destined for bankruptcy. And to be fair, the evidence seemed to support that view. The company struggled through much of the 2000s. Even when it wasn't outright losing money, it was barely profitable. Its stock languished, ignored by nearly everyone except a few die-hard optimists. But if there's one thing the history of Build-A-Bear teaches us, it's that dismissing it as a gimmick was a mistake. Beneath the bright colors and birthday parties was a business model that still had potential. The challenge wasn't whether the bears could sell, it was whether the company could reinvent itself when the fad faded. And as we'll see in the next chapter, that reinvention would come. But first, remember this: Build-A-Bear started as an idea so simple it sounded silly. A gimmick in a mall, born from a child's offhand complaint that grew into hundreds of stores and millions of bears sold. The seeds of the comeback were planted right there in that first St. Louis shop when Maxine Clark realized children didn't just want toys, they wanted memories. Now, before we get to the triumphant comeback of Build-A-Bear, we need to face the grim truth. For a while, this company was circling the drain. By the late 2000s and into the 2010s, the dream of a global teddy bear empire had soured into a nightmare. And to many investors, the story looked finished. The financial crisis drained everyone. If a family was underwater on their $100,000 or $1 million home, they weren't thinking about spending an extra $100 for their kid at the mall. Shopping malls across America emptied almost overnight. Discretionary purchases like build-your-own toys were among the first to go. Build-A-Bear, so dependent on bustling malls and children's birthday parties, was maximally exposed. The magic of the experience model didn't matter if no one was coming through the door. In 2009, the company posted painful losses. Analysts, never slow to kick a business when it's down, started lumping Build-A-Bear in with other failing mall retailers like KB Toys. Haven't heard of them? That's for good reason. The stock slid, and for a while, investors assumed the company would fade into irrelevance. After all, what chance did a teddy bear shop have in a world dominated by iPads, Xbox consoles, and smartphones? And let's be honest, Wall Street isn't sentimental. No analyst ever wrote a report titled, "Buy this stock because kids look happy when they stuff bears." They wrote about falling same-store sales, shrinking margins, and the death of the American mall. And the data looked brutal. Through the early 2000s, Build-A-Bear floundered. It wasn't dead, but it wasn't alive either. More like a zombie retailer, staggering forward with little direction. At one point, the company was closing stores faster than it could open them, desperately trying to cut costs. In the eyes of investors, it had gone from a novelty success story to just another struggling retailer destined for liquidation. And then came the infamous Pay Your Age disaster in 2018, an event so chaotic it made headlines around the world. The idea, at least on paper, was brilliant. To celebrate birthdays and boost traffic, Build-A-Bear offered customers the chance to buy a bear for the price of their child's age. If your toddler was 3, you'd pay $3 for the bear. Sounds like a clever promotion, right? Cheap bears for families, lots of goodwill, big crowds. Well, crowds they got, but the company wildly underestimated just how many parents would show up for a cheap bear. Stores across America and the UK were mobbed. Queues stretched out the door and around shopping centers. In some locations, police were called in to manage the chaos. Parents fumed as stores shut down early, citing safety concerns. Children left in tears. Social media erupted with anger. What was meant to be a celebration turned into a PR fiasco. The Pay Your Age debacle became a cautionary tale. Instead of cementing Build-A-Bear as a fun family brand, it made it look incompetent. Reporters mocked the company. Parents vowed never to return. For Wall Street, it was just further evidence that Build-A-Bear was a joke, an out-of-touch mall dinosaur stumbling from one disaster to the next. And yet, underneath the mess, something important was happening. In 2013, Sharon Price John had taken over as CEO. A retail veteran, she walked into a company losing nearly $50 million a year. Most people wouldn't have touched it with a barge pole, but she believed there was still magic in the brand, if only it could evolve. The early years of her leadership were brutal. Stores were closed, costs were slashed. The business was reshaped around profitability instead of blind expansion. By the time the Pay Your Age scandal hit, she had already begun steering Build-A-Bear away from the brink. She couldn't stop the PR nightmare, but she could make sure the company didn't collapse under its own weight. Still, from the outside, nobody cared about nuance. All Wall Street saw was a gimmick gone wrong, another mall retailer floundering. In the 2010s, the stock often traded for just a few dollars. At one point, the market valued the entire company at less than the cost of a medium-sized Starbucks acquisition. Investors wrote it off as irrelevant. It looked irrelevant. When parents could hand their children an iPad or buy them Fortnite skins online, who needed to drive to the mall to stuff fluff into a teddy bear? By 2018, Build-A-Bear felt like a relic from another time. But beneath the PR disasters and mall closures, Build-A-Bear still had one priceless asset: brand loyalty. Children still loved the experience. Parents still remembered the excitement. And increasingly, a new category of customer was emerging: adults. Think about it. Those young kids in 2002 had older brothers and sisters who were too cool for the teddy bears. But now they were young adults and wanted to buy the bears they never got a chance to have as a young kid. We'll talk more about the kidult market in the next chapter, but this is where the seeds of the comeback were planted. Even in its darkest days, Build-A-Bear had customers who cared, and Sharon Price John saw that loyalty as the company's lifeline. For now, though, it's important to remember how bleak things looked. Its once bright future had been reduced to a punchline about cheap bears and angry parents, which is why what happened next is so astonishing. The very company everyone wrote off, the company mocked for gimmicks and PR disasters, would go on to stage one of the most remarkable turnarounds in recent retail history. If Chapter 2 was about decline, this part is about survival. And not just survival, but bloody reinvention. Because in 2013, when most people had already written Build-A-Bear's obituary, the hero the company needed had arrived: Sharon Price. John inherited a company losing nearly $50 million a year, mocked in the press and written off by Wall Street as a tired mall gimmick. Her solution wasn't glamorous. She didn't promise flying bears or holograms. She did something far rarer in retail. She cleaned house. Weak stores were shut. Leases renegotiated, and the focus shifted from as many malls as possible to only where it actually works: Orlando, Las Vegas, tourist hubs, places where families want to spend money on experiences, not half-empty malls clinging to life support. But the turnaround wasn't just about pruning. She understood the bear itself wasn't the product. The experience was, so she doubled down on what made Build-A-Bear unique. The ceremony, the memory, the idea that you weren't just buying a toy, you were building a friend. It sounds cheesy, but it worked. Families kept coming. More importantly, adults started coming back too. This is the genius move, spotting the rise of the so-called kidult market, grown men and women happily buying plush toys for nostalgia, gifts, or just because they wanted one. By 2025, these kidults made up nearly 20% of sales. Add in licensing deals with Pokémon, Star Wars, Hello Kitty, and suddenly Build-A-Bear wasn't just competing in the toy aisle, it was selling collectibles, limited runs, fan crossovers, exclusives, all high margin, all catnip for both kids and adults. And then there was the digital world. Sharon Price pushed hard into e-commerce, letting people design bears online and send them as gifts. It was clunky at first, but by 2025, online sales made up 20% plus of revenue, growing faster than the stores. Throw in a loyalty program with 10 million members, and Build-A-Bear had quietly transformed into something far sturdier than a mall fad. By the mid-2020s, the results spoke for themselves. Rising revenues, fattening margins, zero debt, and a clean balance sheet. Investors who had once sneered at the stock now looked foolish. What was dismissed as a silly children's retailer had been rebuilt into a lean, profitable, experience-driven brand. And that is the bit most people miss. Build-A-Bear didn't reinvent itself by abandoning what it was. It reinvented itself by finally understanding it properly. Not a toy company, not a mall tenant, but an experience company that happens to sell bears and charges a small fortune for tiny bear shoes while doing it. In 2022, Build-A-Bear almost doubled its revenue in a single year. Think about that, doubling sales at a time when most retailers were still limping out of the pandemic. And yet Wall Street still valued the entire company at less than what it made in sales over 12 months. That's not just a bargain, that's daylight robbery. Fast forward a few years, and the numbers started to pile up. By 2025, quarterly sales hit record highs, margins fattened up, and the company was pulling in more profit than at any point in its history. And they managed all this without a mountain of debt. No financial tricks, no Silicon Valley smoke and mirrors, just selling bears, clothes for bears, and experiences that kids and adults couldn't resist. The stock reacted the way you'd expect. In early 2024, shares traded for the price of a takeaway dinner. By the summer of 2025, they'd rocketed more than 20 times higher. $1,000 invested back then would now be worth $25,000. For perspective, Nvidia, the king of artificial intelligence, the company supposedly powering the future of civilization, delivered about half that return over the same period. Impressive, but not teddy bear impressive. And here's what makes it almost comical. The business still isn't priced like some flashy tech unicorn. The profits are real, the cash is real, the balance sheet is clean. This wasn't a meme stock pump or a one-off gimmick. It was quarter after quarter of steady, boring success, the kind of thing that makes analysts quietly raise their forecasts while pretending they always saw it coming. So the scoreboard doesn't lie. What looked like a children's novelty shop turned out to be one of the most reliable money-making machines on Wall Street. And the fact that almost everyone missed it tells us something very important, something we'll tackle in the next chapter. Why investors so often overlook the hidden gems hiding right under their noses. By the time Build-A-Bear was racking up record quarters, a strange question hung in the air. Why did so few people see it coming? The clues had been there all along, hiding in plain sight. But Wall Street, as it so often does, was looking the other way. The first blind spot was glamour. Investors were too busy chasing the shiny stories, AI chips, electric cars, crypto bubbles, to bother with a shop selling plush frogs and tiny shoes. A teddy bear retailer didn't sound clever enough to brag about at a dinner party, so the clever people ignored it. The second mistake was narrative. For years, the only thing analysts wanted to say about Build-A-Bear was, "It's mall-based, and malls are dying." That single phrase was enough to scare them off. They never bothered to notice that Build-A-Bear was already escaping the malls, popping up in tourist hubs, airports, and online, turning the shop itself into an attraction. And then came the biggest oversight of all: nostalgia. The rise of so-called kidults, grown men and women proudly buying toys for themselves, was treated like a quirky footnote, not a market trend. But for Build-A-Bear, it became a fifth of all sales. While analysts laughed, adults queued for Star Wars bears, Hello Kitty collabs, and limited edition drops. The bears stopped being toys, they became collectibles. These so-called adults are actually just enlarged kids anyway, so it shouldn't be too surprising they eventually came back. Because the growth was so steady, almost nobody paid attention. It was a silent killer, but reversed. The truth is simple. People missed Build-A-Bear because it didn't fit the story they wanted to tell. They were looking for revolutions, not reinventions. They wanted sci-fi visions of the future, not stuffed animals sold at birthday parties. And so the gem sat there, ignored, until it was too obvious to deny. That's what makes this comeback so satisfying. It's not just about the money. It's about the reminder that markets are full of hidden gems, ordinary businesses doing extraordinary things, if you care enough to look. So where does the story go from here? After all, the past 5 years turned a forgotten mall relic into a market-beating hidden gem. But the question now is whether Build-A-Bear can keep the magic alive, or whether this was a one-off fairy tale. For now, the momentum looks real. The company is expanding again. 60 new locations planned this year alone, bringing the global footprint to more than 600 shops. But these aren't the tired mall outlets of yesterday. They're in tourist hotspots, airports, theme parks, places where families arrive ready to spend. The flagship planned for Orlando's Icon Park isn't just a store. It's a multi-level attraction designed to be an experience in its own right. And then there's the kidult market, which still has room to grow. Limited edition collaborations are proving sticky, not just for children, but for adults who grew up with Pokémon, Star Wars, or Hello Kitty, and now have disposable income to spend on nostalgia. In some cases, those collaborations turn a $20 toy into a $100 collectible. That isn't a fad, that's a new revenue engine. Digital is another front. E-commerce already accounts for a fifth of sales and is still climbing. Apps let people design and customize bears at home, then pick them up in-store. It's not the flashiest technology, but it's clever. Online sales feed store visits, and store visits drive loyalty. It's a loop that keeps customers coming back, but let's not sugarcoat it. Risks remain. Tariffs on imports could take millions off the bottom line. Economic downturns could cut discretionary spending, and competition never sleeps. Giants like Mattel and Hasbro would love to claw back market share with their own experience-first shops. Even Canva and Disney stores nibble at the same audience by blending merchandise with entertainment. Plus, if your Uber driver starts bringing up the fact they made a couple $1,000s trading Build-A-Bear options, we're probably at the top. Yet, Build-A-Bear has one weapon most retailers would kill for: emotional connection. You don't haggle over the price of your child's birthday party. You don't quibble over a teddy bear wearing your favorite franchise costume. When the product is tied to memory and meaning, price sensitivity melts away. That gives Build-A-Bear room to navigate costs in a way commodity retailers never can. So, can the bear keep compounding? The safe answer is modest growth, mid-single digits, steady profits, nothing spectacular. But if nostalgia and experiences keep compounding the way they have, if international partners deliver, if kidults keep buying plush toys for their shelves, then this story may have more chapters to come. For now, the bear has done something remarkable. It proved it wasn't just a mall gimmick, but a brand strong enough to reinvent itself and outpace some of the most powerful companies in the world. That doesn't guarantee another 25x run, but it does prove a point that investors should never forget. The next hidden gem may look silly at first glance. The boring businesses of yesterday could just be the next 20 baggers of tomorrow. So there you have it. An unlikely comeback stock saved by a CEO with a strategic and straightforward vision. A teddy bear company ended up outpacing Nvidia, one of the most advanced technology firms on Earth. Build-A-Bear proved that hidden gems can be found when nobody's looking, and that the quote-unquote lame businesses often deliver the biggest surprises. Subscribe, and I'll bring you more strange business stories that show how the market's unlikeliest winners can come from the most ordinary places.